Are you afraid to buy a home in today's rising interest rate market? Well, it's still a great time to buy, and here's why. I'm Rachel Inman with the Your Smart Mortgage Guide channel, where we talk about all things home loans. So first, let's talk a little bit about the economy. When the economy is strong, interest rates tend to rise alongside the economy growth. And good news is we're bouncing back from a pandemic, which means our economy is strengthening. Economists and investors both agree that we are on our way to an end of the pandemic economic impact, meaning this year we're going to see some great recovery, and here's some proof. Today's unemployment rate is 3.8%, which is down from 2020's unemployment rate of 6.7%. Economists generally agree that we will experience record inflation this year, which we have already experienced in the first quarter of this year. And investors and economists are also in agreement that we are now experiencing some global supply chain kinks. However, JP Morgan recently shared a very optimistic perspective on our overall economy, saying, "Over the medium term, we expect the global economy will work to solve the problems that emerged in 2021. The report said as the pandemic fades, consumers should redirect spending from goods and towards services." It continued, "Meanwhile, the bank added that supply chain bottlenecks will alleviate and that globalization will keep the price of goods in check, as it has for the past 2 decades. All this to say, it is very normal for interest rates to shift and for interest rates to rise in a climate of economic inflation. So now that we've talked about our current economic climate and maybe where we're headed, let's talk about those rising interest rates and how they may impact you as a buyer and how they may impact a seller as well. So first, let's start with you. If you're buying a home, interest rates rising are going to affect you because they're going to increase your mortgage loan costs, meaning they're going to increase your monthly mortgage payment. From a home buyer's perspective, as mortgage interest rates increase, your affordability or your purchasing price range will be decreasing. For example, let's say you want to purchase a $400,000 home and your lender has approved you at $400,000 and has shared with you that $400,000 is your maximum purchase price. And let's say they've given you the interest rate of 4%. Well, what happens if all of a sudden that 4% interest rate turns into 5% because of market inflation? Now, at the new 5% interest rate, your maximum purchase price range is $355,000. This means that since your interest rate increased 1%, you are now reduced by $45,000 in your purchase price range. If you're wondering how we calculate your maximum approval price range, we use something called DTI, which is debt to income ratio. And if you'd like help determining what your debt to income ratio is, you can click the link below and schedule your free home loan consultation with me and my team. So now let's talk about how rising interest rates can affect sellers and property home values. Due to rising interest rates and home buyers now having less purchasing power, meaning less funds to offer for your home, sellers may be concerned that they may get less for their home or that there's just less offers out there coming in to their home. Well, I have good news for you. In today's current market, we actually have low home inventory, meaning there's not a lot of homes up for sale right now as compared to historical figures. And this is across the nation. There's low home sale inventory. So let's talk a little bit about supply and demand, because this is actually a great thing if you're a seller today. It's simple supply and demand. There are the same number of home buyers out there today as normal in this time of year. So that's the demand, right? People wanting to buy homes. But supply is low because there are less homes on the market for sale than historically speaking. So supply is low, demand is high or has been unchanged, which means home values should not be decreasing. We should actually continue to see regular and normal appreciation in homes as we move forward. We know that property value and housing prices directly correlate the mortgage rates, but what underlies both scenarios is the health of the economy. If the economy grows fast enough, rising mortgage rates will not have as great of an effect on the property value and housing prices. For example, if mortgage rates increase 1 point, monthly payments increase by $238. However, a strong economy allows employers to increase salaries enough to help compensate for the rising interest rate. As long as the economy continues to grow and we continue to see job growth and wage growth, a rise in interest rates should not paralyze the housing market. So now what? I was pre-approved for a home purchase price last month, but interest rates have risen. What do I do? You should ask your mortgage lender, and your mortgage lender should be offering to refresh your pre-approval. Review what you purchase or what you qualify for now in a home purchase price, your monthly payment, and your closing costs. You should also review the options to possibly buy down the interest rate if you think you're going to be in this home long term. Ask your lender to show you the difference between a few different interest rates, how that would affect your monthly payment, how much cash out of pocket it would take to buy that interest rate, and how much can that save you over the life of the loan. Most loans are 30 years. In summary, the rising interest rates we see today is great proof of our strengthening economy. And it's still a great time to buy a home, and you should just refresh your home buying plan to make sure that purchasing a home and making this investment is a great fit for you and your family's financial needs. YouTube thinks you'll like this video next.